Welcome to TheoTrade. This is Don Kaufman. First and foremost, I would like to invite each and every one of you to attend the In-Out Spreads Class 2018 edition. You can attend live this Saturday, February 10th from 10 a.m. to 1 p.m. Eastern Time. Again, I will be the host of the class, and you will be given lifetime access to the on-demand recording. In addition to it, we will also provide you a full month access to TheoTrade, which I'll talk about here momentarily. What you have to realize about the in-out spread, listen, this is the go-to strategy that I discuss in many of these evening videos. You know, in a marketplace packed with volatility right now, where, right now, listen, we're looking at the S&P's down 52 points, still with 40 minutes left in the trading day. Whether you're trading Facebook or Apple or Google or Amazon or Tesla, whether you want to be long or short, this in-out spread can mitigate your risks. For the most part, we're going to get into a lot of detailed criteria like, hey, look here at Facebook and how many different expiration cycles there are. We'll actually pinpoint the most effective expiration cycle, okay? We'll pinpoint precisely which options you buy, which options you sell, all of the opening criteria, all of the closing criteria. That's what's critical about understanding and really trading these options. We'll talk about, again, which stocks are going to make some of the best candidates. As I said, what strikes an expiration, how to obtain a high probability. These things can be used in IRAs. Okay, you have to have a minimum of $2,000 in the account, but nevertheless, this is also effective if you have a six-figure account. In addition to it, we're providing you a full month access pass to TheoTrade. What do we offer there? Everything from all day, every trading session, daily coaching sessions, live trading chat room. Okay, you have access also to over 2 years of our archives. If that is not enough, we'll also give you all the studies and indicators. You'll have access to the Start Here tab where you can actually go through. There are 22 individual videos to get you started if you're a little bit newer ultimately to this business. If you want to search the archives, type in any strategy you can think of, search the archives. As I mentioned, if you want to, look at some of our studies, some of our scans, we're going to give you access to all the TheoTrade shared studies and scans. In addition, we even email out trade ideas throughout the course of the month. Again, please don't miss it. It's the In-Out Spreads Class 2018 edition. Check out the web address. It is theotrade.com/IN18. Again, theotrade.com/IN18. The course is $199. I think you'll agree, well worth it. Attend this class this Saturday. Now, let's get to this evening's video.
Hey, thanks, Don. Good evening, folks. This is Doc Severson for the Theo Night Report for Thursday, February 8th. Okay, let's analyze what's going on in the market, and we'll finish out today by telling you what kind of positions to be taking in this volatility. There are so many lessons that we can pick out of today's market action, and I'll do that as I go along today and just sort of pick apart what's happening in the markets. The first one that I'll throw out there is that when everybody sees the same thing, when everybody generally agrees on what's happening, that means that they're collectively wrong. And I think what happened here over the last couple of days is the buy the dip crowd saw the nice candlestick on Tuesday and just assumed that, well, okay, there's the dip. We've been waiting for so long for the dip, and let's jump on board. There was, after all, quite a bit of cash still sitting on the sidelines waiting for this dip that has been oh so long in coming. So, of course, when that dip shows up, all of a sudden, they run straight into the wall of forced redemptions and margin calls by all the short volatility firms that had to liquidate over the last couple of days. And they've been hedging by going short S&P futures, amongst others. So do you think the buy the dip crowd has got a strong hand or a weak hand? Of course, they've got a very weak hand, and they've been folding all day long. Now, just from a technical perspective, yesterday was a good example of a shooting star, and a lot of times these major moving averages, I don't spend any time looking at them or really analyzing them, but you'd be surprised how often that they come into play as former support becomes new resistance on the way back up. This red line is just the 50-day simple moving average. So now this green line down here is going to come into play next, perhaps, and that is the 200-day simple moving average. And the reason that I say that is because I'm looking at the S&P cash index now. That's not actually the true underlying of the S&P. The true underlying of the S&P is actually the futures contract, because it trades almost 24 hours a day. And of course, there is no underlying behind the SPX. So now when we look at this, we get a little bit different picture of what's going on the ES. Now the ES has actually gone down to 12.1% and 349.5 points over the last few days. And you can see on Tuesday, actually it traded much, much lower overnight and did tag that 200-day moving average during the overnight session. So looking at this collection of candlesticks, I think you'd have to say that a retest of this bottom is almost mandatory at this point. I'd be very surprised if we don't see the price undercut this and at least flush this out. Now, what would be a better, whether or not you want to call it a double bottom, actually this would almost be more of a tweezer bottom pair, is I want to see an undercut of this. I want to see the price coming down and undercut Tuesday's low. What this does create generally is a washout, because you're going to see people with either stops, or you're going to see long limit orders down here at about 25.25, people that want to go long down there, or people that are already long with stops down there, and that just becomes an attractive target, and you might see a tremendous amount of liquidity down in that area. So I've switched up the chart here. I've gone over to the Dow futures because this one was particularly dramatic the other day. This is Monday afternoon. But what we saw was a general decline, and then all of a sudden it accelerates into a waterfall decline. And this is what I'm looking for. As the price undercuts the Tuesday's lows, this is what I'd like to see. I want to see that just completely flush out into an almost impossible drop. And for those of you that are following at home, this is almost an exact opposite of what we've seen into January to the upside. This is typically what you'll see. You'll almost see a mirror-like reaction on the correction to the downside based on how complacent and parabolic the upside was. All of that excess has got to be flushed out to the downside, and this is one way to do it, is to have that waterfall decline. And this is very reminiscent of what we saw on the flash crash way back in 2010. Okay, so back out to our daily and longer term charts. Let's zoom out here and talk about this from the bigger picture. So again, shorter time frame, what I'm expecting is a good old flush out to the downside and just absolutely obliterate any weak hands left. Everybody's got to be made to feel that there is no hope left in this market. And then and only then will we get the washout and then the subsequent bounce. Now, let's zoom out for a second here. Is this a bear market? No, it is not. This is simply, from especially a larger time frame perspective, this is simply just a pullback. So let's get a grip on things. I know it's easy to get emotional with this, but if you zoom out and look at this objectively, this is just a weekly pullback. And this is barely still just registering on the monthly chart. There's a long way to go. And as we know, tops are a process. Tops are a process. They tend to be very torturous events before they actually release to the downside. We can just simply go back and look at these previous tops to get an idea of how torturous they were before they finally did release to the downside. In some cases, they never really did. So again, this is not a monthly downtrend. This is not even a weekly downtrend. This is a weekly swing down is what we're seeing right now. Before this truly releases into the bear, we will get, and this is just the shot over the bow that begins things. This is the first act. We will see a very complex topping process, and eventually a lower high will turn up. And if this decides to go lower, then and only then will it start to work lower as we move from this sideways and volatile phase into volatile and trending, which is another code word for bear market. So one of two things will happen from this as we go through this very volatile range-bound process over the next few months here. It can either break out to the upside again, or it can break to the downside. So how are we going to be trading this in the short term? Well, a few different ways, and usually the simpler the better when it comes to this. Now, when we have these high volatility bottoms like this, we have implied volatility just shooting to the moon at this point. So we have very, very high implied volatility. Not quite as high as it was on Monday, Tuesday, but still it's elevated right now. So I'm going to look for these types of moves to the downside, these undercuts, and these are very emotional bottoms as a good time to stand in front of the freight train and sell in that direction. So in other words, what I would do is look to sell in this direction, put spreads that are going to be way out of the money. So we're going to be able to do this. We're going to be able to successfully do this. We're going to use that fear, sell that fear, and set up put spreads out of the money. And then we're going to see the price at some point rebound, and it doesn't take that much because the rebound is also going to come with it. The implied volatility will crush back down again, and we'll be able to clear the position. We don't have to wait for the lower high to set up, to roll over, and then put stress on the position. Now, is that a comfortable position to take? No, of course it's not. But that's why it's got edge to it. Now, if you also think about what's going to be happening from there, at some point from this period of disgust where everybody's extremely negative, all the news will be negative, you're going to see a rally start from the ashes. From the ash heap of this sell-off, you're going to see a rally come back up again. We want to look for that because, again, nobody's going to be looking for the rally to come from there. Everybody's going to be too convinced that the world is over. And so from that rally, we're going to look to go long on some kind of long delta neutral trade. Typically, an in-out spread would be an excellent vehicle for something like that, or the long stock if we have the right conditions for that. Then as the price approaches former highs again, everybody's going to assume, again, it's the assumption part of it, they're going to assume that it's V-bottoming. And I will look to sell outside of the current range above there. So that's another way to leg into a high probability condor, is simply to use the price action to help catapult the price beyond the current range. So not only are we going to be looking to sell premium, and it's going to be a little tougher as the price rallies up because we'll have that collapse in volatility again. So you won't get quite as much bang for the buck. You won't get as much distance on those call spreads. So you have to be patient to wait for the price to fully rally up to there because, as the car guys say, there is no replacement for displacement. And then what you'll see up at the top is eventually at some point we will do much like what we saw back in these periods here. We will see a lot of volatility up here. We'll see a lot of consolidation to work that off. And then if we're due for another shot to the downside, that's when that will come. So we'll have plenty of time to be able to set up. Usually tops are not spiky like this. They don't come down immediately. They usually set up and torture people before they release to the downside. So we'll have plenty of time to set up some short delta hedge type positions. So I'm going to leave you today with one thought. If the trade that you wish to place does not feel comfortable, it's probably the right one to take. And of course, the converse to that is true as well. Thanks for listening, folks. We'll catch you tomorrow.